Hi, everybody. The Dissenters. And I should mention Jim Chanos was going to be on this panel, but he dissented so much he didn't come. But he's actually in jury duty, so we'll have a second of silence to thank him for his service. But I want to start with the Dissenters. That's like, are you a dissenter? Victor, I'm going to start with you. Is that how you look at yourself?
No.
The distressed? How are you?
You know, this you might get a chuckle out of this, Dan. We think of ourselves more as like a doctor.
Really?
Or,
a doctor?
Or more like a surgeon. You've got a business which has a problem. You've got capital structures which have issues. And for us, what we do is to kind of fix that and to even intervene to kind of improve businesses.
The fixer.
Fix businesses.
Although that can have double meaning. But so you're the fixer. How about you, Boaz?
I'll take the nickname, the dissenter, because we are often on the other side of a situation that has very strong technicals pushing it into an extreme level. So just as an example, we're credited with being on the other side of the JP Morgan London whale, and to be on the other side of a firm, it's a decade ago. Okay. What have you done for me lately?
Well, yeah, what have you done the last?
But certainly to take on that other side, you're effectively contrarian, a dissenter, and we relish that role as long as there's a good economic basis to do so, as hopefully we'll get into when we talk about closed-end funds, which is another place we're dissenting.
Well, I'd be remiss not to, I noticed in your background you studied philosophy at the University of Michigan, so I want to ask, as a philosopher, do you have a philosophy that guides your philosophy of investing? Do you have any favorite quotes?
So no one's ever called me a philosopher before.
Okay.
Let's be very clear.
And they may never call you one again.
Yeah,
like,
but
this is a rare moment.
I do have some quotes. Maybe we'll have time for one of them. I'll just say at work as an arbitrageur, where we're looking for a great trade, we're looking for something at a certain level of cheapness. I'm constantly using Voltaire, who's famous for saying the perfect is the enemy of the good, is that you can find a great trade. It's not a perfect trade. At what level do you strike? And if you strike at that level and you don't get enough, and then it moves a little bit in your favor, are you going to let that perfect level that now seems off in the distance stop you from having the position right-sized? And so this constant challenge of a relative value investor, an arbitrageur, is what is that perfect level? Is something where you can end up really missing big trades because you were being a little bit short-sighted about looking for perfection.
That's a great philosophy for an investor. It would be problematic for a doctor, if right? So what, do you have one yourself? Do you have any quotes?
You know, I like reading Buffett.
Buffett?
He's got all these kind of very common sense kind of things, and there's so much richness, there's so much wisdom in there. So the one I like, particularly for today's times, a rising tide lifts all boats, but as the tide goes out, you figure out who's swimming naked. Well, guess what? We are in that moment of time.
Who's swimming naked?
Well, can I tell you in a very simple way? You've had trillions of dollars invested in buying businesses, buying assets with 0% interest rates. Short-term rates are 5%. They're going to be higher for longer. Hey, we're going to figure it all out over the course of the next 3-4 years.
Okay, so that says a little bit about your view of the Fed, does it?
It does. I think Diane and I, we talked earlier, and one of the things we keep saying is, look, we're not sure, is this a soft landing? Is this a recession? Is it a shallow recession or a deep recession? Around this room, we can all debate it, like what is it? But the Fed, every time, I've been through 7 credit cycles, every time I've been...
We congratulate you on that. Congratulations.
Survived.
You survived, okay.
Right. But every one of those 7 cycles, the Fed was your friend. They reduced interest rates. They even came up with this idea of QE in 2008, right?
Right.
Well, they're fighting inflation. They're not your friend. Rates are higher for longer. Put it all together, regardless of whether you're in a soft landing or a shallow recession.
The Fed is not your friend.
And the result, we are in for a 4-5 year slog. As we work through these higher rates and what they mean to kind of valuations, especially in the debt markets with what's coming, the Fed is not your friend. Plan on a 4-5 year slog as we think about it.
That sounds like we've gone from the dissenters to the depressors, but it's good. It's a good, So, any reaction to that?
Well,
more beloved?
trust in Victor, but even if we went for wisdom of crowds and we asked this room, what's the chance of something like a hard landing, something like a recession, whether that number ends up being 40 in the next 12 months, that number ends up being 40% or 60%. I look at it through what is the market pricing in? What are the range of outcomes? Victor might be right, I think he's right. He might not be, or he might be right later. But if you look at the last 6 recessions and say, given that those occurred, and let's see where credit spreads got to, and this might be a better or worse example of versus the average, but if you take those 6 recessions and you see where we are today, you say, well, if that happens, we'll get to that average. And if that doesn't happen, how much will we lose, let's say, being short, which is in its own way a dissent, which we do at our firm. Very little chance
we can
is priced in.
fabricate quotes for Jim since he's not here, the short seller, but
Yeah, he deserves his own quotes.
I know.
So we look at it and say, even if we didn't have that crystal ball, it's easy to take the other side because so little is priced in. Even outside of the esoteric of credit spreads, something that all of you have seen, written about, and follow to some extent is the VIX. And you could say, is this the moment where the VIX should be at a 3-year low? Is this, given the uncertainty about it is the uncertainty about inflation, even that the existence of a war in the Ukraine, the private credit market appearing like the default rate is going to rise almost no matter what, is this that moment that uncertainty is so low that it's the lowest even before some of those things like transitory inflation were taken off the table? And so I look at the market now and see incredible complacency, whereas you could find a lot of safety and security in T-bills and earn that 5, probably going to closer to 5.5% or more in the safety of T-bills, wait for the chaos that Victor envisions, and then invest at much more opportune times.
So given this environment, and you're envisioning chaos, potentially, Victor, let's talk about the now. What's your most compelling investment in this environment?
I think I overstated if I tell you chaos. I'm not
no, that was an interpretation.
Right. I'm not trying to suggest there's chaos coming, right? But all I'm just trying to suggest is 5-year slog, slower economic growth, higher rates, trillions of dollars of debt maturing, right? As these deals come to roost.
Yeah.
That's all I'm suggesting. Now, today, so like what's interesting in a world which looks like what we are doing? It's debt. It's all about debt, we think. So, for example, look at debt maturities for leverage buyouts. There aren't that many in 2023. They step up in 2024 and in 2025 and 2026. Look at Europe. Europe's already in a recession, right? Germany has had 4 negative quarters out of 5. Look at Europe just where we are today, and see with it.
Does that make it especially interesting as an investment opportunity?
Oh my gosh, yeah! Like you get these kind of slowdowns, you get these debt maturities. By the way, office property, everybody's hiding, right? The bid is here and the offer's here. The commercial office property maturities are coming right now, next year, year after. All this stuff is going to start to get repriced quite dramatically. And all those repricings, that's the opportunity. If you have fresh pools of capital, fresh eyes to look at it, that is the opportunity. So I think to our way of thinking, debt, a real focus on investing in debt, and through debt, getting control of businesses, getting control of properties is kind of the opportunity.
Fixing them. So what about for you, Boaz?
Well, first, just to comment very briefly on what Victor said. To me, after 2008, we entered a period where the sell-offs were few and far between, and they were very brief. The second biggest sell-off of all time, next to the Great Depression during COVID, but the fastest recovery. You blinked and the market was back. And so I think the investors today, having lived through all that QE, are not ready for slog. To me, I hear in that slog environment of a few years of complicated workouts and defaults and maybe a recession is something that could be chaotic because investors are just not used to it not being a buy the dip type opportunity. Where we're focused is on arbitrage, as I alluded to before. So something very simple for you all to appreciate is that on the New York Stock Exchange, on the London Stock Exchange, there are almost 800 companies that are called closed-end funds. They own portfolios of assets, whether it's municipal bonds, high-yield bonds, loans, equities. And those funds, because they're closed-ended, if you want to sell it, it's just like a stock like IBM where you sell it in the market to somebody.
Right.
That's so different than a mutual fund where you can redeem it back to the manager, let's say BlackRock, or an ETF where you can redeem it back to the manager and always get your money back. So the opportunity today is that a quarter of that market can be purchased for discounts to their objective fair value of 15 to 20%, and some even 30%.
That's what you're doing?
That's what we're doing because it's hard in the investment business. It's hard to make 10%. It's hard to make 8%. But to buy a closed-end fund at a 20 discount and then work to close that discount through activism, which is something we're very involved with, has been super profitable for the last 8 or 9 years. And as we talk today, the discounts are enormous. And despite us being in a bull market, and so our firm is an activist on a number of campaigns, including with BlackRock now, where all they have to do is press a button to turn their closed-end fund into an open-ended fund, and hundreds of millions of dollars would accrue to the existing investors.
Anybody from BlackRock, raise your hand? No, well, that's after. But let me ask, in terms of the time we have left, let's look ahead around the corner in terms of what's on your radar, maybe not an investment right now. Victor, I'm going to ask you first.
I touched on it a little bit. Europe is smack bang on our radar.
And it wasn't this time last year?
It wasn't. You know what happened, especially after COVID? It was so quick, the drop and then the recovery. We have large investment teams in Europe, a real focus on Europe. We didn't do that much in Europe in 2020, 2021. Now, in this sloggy world, in a world which is Europe's already in a recession, as I was describing earlier, that opportunity set has just opened up dramatically. Okay. So I think focus on Europe, and by the way, don't go to Italy. Don't focus on Italy.
Don't go to Italy.
I'm literally going to Italy tomorrow. I'm flying. I'm on the 4 o'clock flight, Victor, tomorrow to Rome. So
that part of Italy I would go to.
Okay.
Right? It is, but don't make investments there. Don't go to Eastern Europe. Focus on Germany. Focus on the UK. Focus on Northern Europe. And there's a set of. And by the way, it's not all here today. What we've found is our pipeline of deals has tripled in the last 18 months. Half of it is in Europe. And there are about 12, 15 things we are starting to invest in, right? So I think so please, I'm not telling you it's all here right now, go. But just our view is that we are here and we are going here.
This is the soothsayer part, is looking ahead. So looking ahead for you, what's...
So half of our assets are invested in protecting endowments, pensions against a crash, which forces us to be a dissenter and think about what if the world changes. And one of the easiest ways to have crash protection through the credit market is that there is an opportunity, because the credit market is so governed by technical factors, that for a year now, ever since Jamie Dimon said bracing for a hurricane, or Goldman Sachs talked about a tsunami or some other natural disaster, banks have been freeing up regulatory capital by buying insurance, by buying credit default swaps on companies like IBM, Apple, Walmart, Disney, companies that will never have a problem, certainly as a credit. You take that premium, you provide that insurance, and you go and spend it on sectors, cyclical companies, commodity companies, consumer finance companies, that in any recession, many of them will have some sort of problem. And so the difference in price between A and B is very similar, and it allows us to construct a portfolio that doesn't decay. It basically is long and it's short, but back tested against any sell-off, including the most recent ones of last year in 2020, the cyclical companies will see their spreads widen much more than the McDonald's, Walmarts, and Disneys. And so that has really resonated with investors and is something we're doing now to prepare for if and when there's
Great.
a slog.
So dissenters, we have a minute left. I want to give each of you a chance to give sort of a final thought. Victor, I'm going to start with you.
Fasten your seatbelt.
Okay, fasten your, I like that.
It's going to be bumpy. And just make sure that your portfolios are set up for some extreme events like Boaz thinks about, perhaps along the way, but just fasten your seatbelt.
Said differently, I think there's grace and beauty in 5.5% T-bills, and then you can feel so good about yourself when the sell-off happens, and now you say, let me now take that portion down and buy things that experienced a lot of scarcity, or there's a lot of scarcity value in actually buying in that sell-off, and so. So defensive, even though it's really unpopular for the last few months, and we've seen a 20% rise in the S&P, well, we're telling it to you today, not before that rise, and now's the time to be safe.
The doctors, the philosophers, the dissenters, please join me in thanking Victor and Boaz. Thanks very much.